Good morning, everyone, and welcome to the July session of Founders Q&A with Anthony Millin. My name is Lisa Friedlander, and we're excited to be here by Next, powered by Shulman Rogers. Next is an innovative and award-winning model for the delivery of legal services to startup and emerging growth companies. And Founders Q&A is a monthly session we provide for entrepreneurs to come and literally ask Anthony anything. Anthony is the founder and chair of Next, a serial entrepreneur, as well as a venture capital partner. So he is a perfect person to ask all of your burning questions. With that, I will turn it over to Anthony.
Well, great to be with everybody today, and look forward to, like Lisa said, it's a smaller group today with the summer months, but that gives more time to go deeper into any questions anybody has or anything people want to talk about today.
Who would like to kick us off this morning?
Oh, I guess I'll start. It's related to taxes. So I was an LLC and then I converted to a C Corp in March of this year, or in January of this year, rather. Of course, when I was an LLC, I could deduct all my business expenses in my tax return. So but I can't do that anymore, correct?
Once you're a C Corp, once you switched over to become a C Corp, you're not passing through income and losses to your personal return. It's not your C Corp is being taxed at the corporate level. So that is correct.
Okay. So as far as tax liability on the C Corp, they tax only profit, correct?
So right, you would work with your accountant to prepare a corporate tax return.
Right.
And so in terms of how you can carry forward losses if you don't have income to offset it, those are all things you would work on with your accountant. But that is, you're taxed at a corporate level at the corporate tax rate on profits of the company.
Okay, thank you.
Thanks,
As long as we're talking about taxes. Are you familiar with section 174? I believe it is.
I am not. So
well, let me try to explain it. Businesses used to be able to write off the cost of R&D in the year that it was incurred. But now section 174, 175, it requires them to amortize the costs over 5 to 15 years. It's 5 for US companies, 15 for foreign countries or companies. We are starting a network of maker spaces combined with business incubators. Do you think we can use this to encourage businesses to join our innovation labs? If we have to amortize the expenses over 5 years, can businesses write off their membership fees in the same year that they were incurred?
Yeah, so once you get into kind of technical tax questions like that, and whether you can carry over from your maker spaces, that is something, if you're interested, Lisa can certainly connect you. We've got a phenomenal tax team here who probably in a short phone call could go over that with you. But once we get deep tax questions like that, that's not something I would do, and I would normally have one of my tax partners address that, and we're happy to make that connection just to even ask the question.
Right, less complicated. It's not really an issue. It's just wanted to let you know that the Maryland Makerspace Initiative and TEDCO issued the first round of funding to about 20 new maker spaces. So,
fantastic.
Awesome.
That's really exciting.
That's great, Ken. Thanks for sharing that piece of information. Who has a different question?
Hey, good morning, guys. This is Tim. I actually don't have any questions this morning. I just wanted to kind of pop in and listen in. we're running a startup right now. We're about 3 years old, but we just hired a chief commercial officer. We're working with about a half dozen prospective investors now and expecting term sheets. And we have our, first customers we've brought on. We're kind of white gloving those, and we're putting some other pilot projects together. So just a ton happening, and figured I could kind of glean some info off the questions others were asking here.
That's great. No, it's really an exciting time in terms of hitting those different momentum and some of the milestones you have coming up. And as you get in, as you're getting into that process, you're welcome to check in with us, and hopefully there'll be some questions that come up today that will be useful to just understanding the process of what's being kicked off. But congratulations on your progress.
Thank you. Appreciate that.
Yeah, that sounds exciting, Tim.
Yeah, you guys will absolutely hear from us, more from us too.
Terrific. Keep us posted for sure.
I will jump in if that's okay. So I'm Bridget. Good to see you again, Lisa. So I am the founder of a B2B SaaS, a retail tech company here in DC. And my question is about cap table. So it's kind of broad. So really, I just love your opinion. But what I've found over the past year and a half is that sort of several opportunities, I feel like we missed them because we haven't gotten a valuation for our company yet. In my opinion, is that we're very, very early. Lisa knows how early we are. We haven't launched our platform yet. We do have 20 signed customers, but we have not launched yet. But there's been things like advisors who weren't able to join that would have been really valuable if we were able to value their shares and their time, team members that we could have been paying in equity if we had a valuation. What's your opinion on getting a valuation this early?
So in terms of bringing people on to your company, the way it would typically work is you would set up for the company, if you're a C Corp, you would be setting up an equity incentive plan. Once you set up an equity incentive plan, that plan would give you the ability to issue restricted stock or stock options. If people, no stock options are either incentive stock options or non-qualified stock options. For people who are not employees, they get the non-qualified stock options. The valuation that you're looking for at this very early stage is called the 409A valuation. It's not, it's different to a valuation set by an investment in the company, or a valuation cap in a safe or a convertible note, or a valuation of preferred stock, for instance, in a priced round. And there are a number of different service providers, and Lisa can connect you to some. The reason you get a 409A valuation is you want to, the lower the value early on, the more attractive it should be to advisors and people who want to help you in exchange for equity. And so once you have an equity incentive plan, you can issue people stock options, right? For example, that vest over, or early enough on, you could also do reverse vesting restricted stock for somebody more senior. And those normally vest, if it's a advisor, you'll often have what people commit to kind of 2 years, and have it vest over a 2-year period for an advisor. So there's no barrier. You don't have to have raised a round. In fact, it's better for people if it's earlier. And sometimes if it's really early and there's not a lot of complexity, it's not as complex for one of these service providers, third-party service providers, to give you a 409A valuation. That 409A valuation becomes your safe harbor for determining what the fair market value is for the option exercise price in issuing stock options to advisors or employees or consultants who are helping you early on along the way. And that's really, once you have that, you can feel comfortable that you're issuing it at the fair market value, and you set it up to vest over 2 years, and depending on how senior they are, you would work with an advisor, like we work with our clients, to figure out what the size of those grants should be. And the only valuation you need is this third party 409A valuation, which should be south of $2,000. And if it's not as complicated, could even be less than that.
Okay, that's really helpful. Thank you. My only follow-up question would be, would getting that 409A valuation now sort of limit us in our pre-seed, because the investors we go to could say like, well, you're valued at this, like there's no negotiating on terms, we would be raising on safes. So would that effectively become our cap on every safe?
No,
Okay,
the
separate.
valuation that you're negotiating for investors, if they're investors in startup companies, they understand, the 409A valuation is different to the valuation you would put on a cap or on preferred stock financing. They understand the 409A valuation is going to be much lower, and it's going to be, again, it's a different focus for that valuation. Anyone who's telling you because your 409A valuation is low is not somebody who's used to dealing with investing in startup companies.
Got it. Great, thank you.
The two really great questions, Bridget. Thank you.
Sure.
I've got a question. I just recruited a co-founder and a CTO, and what typically in the form of equity do you give a co-founder in a pre-seed startup?
So
Question.
there is really a broad range in terms of how much the company has already been de-risked by the original founder, how much time, effort, whether the co-founder is putting capital in. There are a lot of moving pieces. I've seen it at 5%, I've seen it at 10%, I've seen it at 30%. I think you really want to understand from the way I would be thinking about it is, if I owned 100% right now and I went down to 80%, would 80% of a company that has this person on the team executing with me full-time and helping de-risk and grow the company, is that 80% with this person on the team vesting over 4 years, they're not going to get anything up front, more valuable than my 100% without this person on the team? And then what is it going to take to make this exciting for a person who's taking a huge amount of risk career-wise and job-wise in joining a very early stage company? So the farther along you get, the less someone's contributing to the early de-risking, the smaller that amount will be. And then when it comes to bringing on a co-founder or a partner, that's the way that's the framework that I would look at in making that decision.
Okay, thank you.
But I've seen, anywhere from 5 to 10 to 30.
Okay.
With the key being the vesting, right? Because you want to be able to walk before you run in case things don't work out.
Yeah. So you would do a 1-year cliff and 3-year after that.
Did you see the documentary, the docudrama on BlackBerry on?
I did actually. Yeah.
Did you notice how he was backdating the options?
Oh, yes.
I was thinking about that when I was doing all my co-founder agreements. What did he do that was exactly illegal?
I mean, I didn't see it, but you can't backdate. You can't. I mean, there were a lot of people who got into a lot of trouble backdating options.
Right. What is that? Can you clarify what that means exactly, so I know never to do it?
I mean, I imagine that is all, again, not my core area within the securities laws of expertise, but I am, there are going to be probably people did something like that because you had options that were out of the money at some point in time. The value, you had all of these stock options that had exercise prices that were much higher than the value of what the business was today. And so, you're going, I imagine I haven't seen it, so I don't know exactly what they did, but probably, again, people would probably issuing options back in the money and dating the agreements for those issuances earlier. It's probably something like that. I'd have to see it to understand exactly what they did, but backdating agreements, regardless of the agreement, is not something you should do ever. In any context.
Right. The SEC fined him, I think, to the tune of $160 million.
Yeah.
Laura, did you have a question?
Yes, I did. Thank you. Hey, I am getting ready, as you both know, to doing my clinical trial agreements. And they are, pretty extensive, as you know, they're with the VA and payer plans. And so I'm running these parallel paths because the review process is going to take 60 days with, the VAs and the Blues. And concurrently, I'm raising my 2.3 to actually fund that clinical study. Okay. So, the clinical trial agreements are done, but as I'm sitting here listening to the money conversations right here, I'm curious how, I don't want to set off an alarm, saying something like, this agreement is dependent upon funding, right? Because we're going to get the funding, but how do I put some kind of language, any suggestions, like even one or two sentences that say, this agreement will be triggered by notification of funding or something like that. I'm just trying to think, as I was thinking through some of these finance questions that just popped up this morning.
Yeah, I think that I would like to speak to you more one-on-one. I think it's really important to have that thought through and to understand the exact context of the agreements and what what you're disclosing, but definitely something to put time and thought into exactly what you're required to disclose and structure and how you're doing that.
Yeah, I think, right. I'll schedule follow-up time with you, Anthony, then. Okay. I'll send you a note. Because I actually am getting ready to buy the C package too, because we're getting ready to do all that. But it's this challenge of running the money at the same time, and but at the same time I can't get the money then start the agreements because I'll lose 60 days. So how do I just put some kind of disclaimer in there to make sure I'm covered?
I think that's what I'm saying is typically the key in things is to make sure you've understand what you need to disclose in terms of where you are, and we can look at it, but it's always right. You've kind of got these two pieces that are moving in parallel that are intertwined and in many ways impact each other. But it's exciting that you're making progress on both sides, and we're happy to work with you to figure out how to structure that for both from the raising the funding side and the trial side.
Great. Okay. Thank you. I'll follow up. Thanks.
That's exciting, Laura. Yeah, of course.
So, Laura, this is Jim. Do you have any statisticians on your team?
I do have a biostatistician.
I'm looking for a statistician to do the data analysis of my experiments, and I'm saying some meetings with people on LinkedIn, but I'm also talking to some people that are involved in the biosciences. What I'm trying to do is basically the way I run the experiments when I ran the CIMEX program for DoD and DHS. We had operators in crisis scenarios, and then we had experimental factors we turned on and off in the course of the experiment to determine what impact they had statistically on the mission. And the human beings were part of the experiment. They weren't being trained. And I need someone that can help me design experiments in such a way that the participants don't realize they're part of an experiment. And I need someone also that can interpret the data and generate a good summary that a layman can understand. Those are all big challenges in my world.
So Jim, I just put my email on there. If you want to send me a note, I'll introduce you to my biostatistician's packed because he's a full professor and he's doing 3 RCTs with me. Mm-hmm. But I am glad to introduce you to somebody that can help you, and I'm sure that they can help you find a biostatistician.
Great, thank you.
Yep.
Thanks to you both. Love the collaboration. Stephanie, Vlad, welcome. Any questions at all for Anthony? Stephanie, your audio, we can see that, but for some reason I can't hear you. I don't know if it.
Can you hear me now?
Yes.
Can you hear me now?
Perfect.
Sorry.
Yeah.
No, I just came to listen in. I provide accounting and finance support to tech startups, and a lot of these questions tend to come up. So I like to sit in on these calls.
Terrific. What, do you tend a question that you tend to get more often than not?
I mean, I think a lot of times they're more accounting driven, but like around cap tables, cap tables tend to come up a lot, and can really think of some legal driven questions. But I mean, it's helpful to just sit in and listen to Anthony here.
Terrific. Well, welcome. I did put a link to our partner page. We have a bunch of different accounting and tax partners, as well as 409A and a bunch of other service providers that are all like-minded in how they work with startups. These people are all great. You can reach out directly on the platform, or you can reach out to me and I'm happy to make an intro. Vlad, welcome. Did you have a question?
Nice to meet you guys. I don't think so. I think I'm far behind all of you. Sounds like I'm still developing the initial investor presentation and trying to put together the financials. My question is there some kind of a standard, especially for the financials? I myself have a very strong financial background, and actually the startup is about financial business applications. But I was wondering if there's some standard kind of a spreadsheet or whatever template, so that one develop those in the standard form that the industry is accustomed to.
I mean, when I work on financial models for startups, or see financial models for startup companies, what I typically what you're looking at is up to like a 5-year P&L is kind of the most important thing. And then kind of a summary that is showing kind of revenue and EBITDA. So in your deck, you would just have kind of a revenue line for 5 years and an EBITDA. Sometimes you need 5 years just to show kind of when you start to kind of really accelerate growth. When it comes to financial models, the other pieces, and what I speak to people about, is it's hard to predict revenue, right? Whatever you put down on the revenue side ahead of time for the next 5 years is not going to be correct. But what's important is that your assumptions are detailed, granular, and well thought through. So
I appreciate that. I appreciate it. I'm actually developing a very detailed revenue model by channel, by product, all that kind of stuff. That's what
I've always looked at, and what is how because that's the indicator into how well you understand the business model and the business dynamics. And over time, as you launch, you'll be able to refine those assumptions with real-time feedback. But if you just do like some people do models by saying it's going to be a $200 million market, I'm going to get 2%, but the way, Vlad, you're approaching it from a bottom-up approach is definitely the way to do it. And then also your expenses for the next 12 months. You can't predict your revenue very well early on, but you should be able to predict your next 12-month burn rate incredibly closely. You need to know when you're raising capital, exactly when you run out of money, and what your next 12 to 18 months burn looks like under. You can run sensitivity analysis on the revenue side. So you can say, when do I run out of capital if I hit half my contracts, half my revenue, no revenue, 25% revenue, like understand under those different scenarios, your expenses and when you run out. So those are the three big things with the financial model. 5 years, granular on the assumptions, convey a deep understanding of your business through the assumptions, and then really be very specific in understanding your expenses and how those expenses are going to scale up. And then in your deck, you don't need anything more in your deck than just kind of the revenue and EBITDA. You know, you just want to kind of have us for the 5 years, but because people will want to see people are going to want to see the detailed model when they get into diligence.
Thank you. Thank you. That was very helpful and encouraging.
Go ahead. Thanks, Vlad. Great, all important questions. And Bridget, you had a follow-up on this subject.
Yes, just a quick one. So in that scenario where we're showing, like, for example, when we might run out of runway, should we be including future raises in that? Like in my 5-year projection, should I have our pre-seed slotted in and our seed slotted in, or does an investor want to see it with no future raises?
No, I think if you, I mean, what you would need to, if you have a 5-year model, you can't, and it's a business that needs fundraising, you'll have a P&L and you're going to have a cash flow model, right? In your cash flow model, you need to be able to show when you would need to raise your next rounds and what you're anticipating raising. So, you know, if you can't get from where you are to where you're going without raises, those should show up in a cash flow that corresponds to the P&L. So sometimes you'll build out a full financial or work with somebody who can work with you to build that out. But yes, you would definitely over a 5-year period on the cash flow side of your model need to understand that. But particularly if you're showing losses, you know, people are going to ask how you're going to, you know, where the money's coming from to get through those losses until you break even on a cash flow basis.
Great, thank you.
And just to add super quick, and Anthony, tell me if you disagree, part of the exercise, I think, is for an investor to look sort of inside your mind and think about how you're thinking about your company is going to grow and what you're going to need and whether these variables make sense to them. It's more of a credibility kind of gut check in how the entrepreneur is thinking than being held to the actual numbers that you're putting out there.
For sure. The process of building the model is really important, like Lisa said. And not only for the investor, it will help you understand your business and, you know, the drivers that drive revenue and growth in your underlying business is going to be really important as well.
Yeah. Well, for our final minute or minute and a half, I want to introduce Susan Smith from the next team and call her out to introduce herself, our phenomenal paralegal who we don't get to see on these often. Susan, introduce yourself to the group before we depart for the day.
Hi, everybody. I'm the paralegal for Next. I have been for about 1.5 years now. Before that, I was the legal admin for Next from the beginning when Anthony created it. I love this team. I love what it does. I can't say enough good things about it. And I just wanted to hop on here and see how this was going today.
Thanks so much, Susan.
Hi,
Great
Susan.
to see you. Anything from your
Hi,
perspective,
Tim.
from what you do and see every day from the paralegal side, pieces of advice, tidbits, words of wisdom?
Oh, gosh.
They'll put you on the spot.
I know.
If you're raising, Susan helps with our filings. When you're raising capital, anytime you're raising money, one of the things you need to do is make your securities filings.
Yes.
And on our team, whenever you're out raising a round of funding with us and you get to do the Reg D filings with the Securities and Exchange Commission and the state filings, Susan is the person you'll be working with on our team to make those. And it's really important to understand whenever you raise money, there are security issues at play and that you have to follow under the securities laws. And often people don't, especially early on, and you know, they come to us and we kind of try to figure out how to help them get that remedied. But the best remedy is doing it correctly up front. And Susan is a key person on our team, helps our clients to do that. So
Absolutely. Great to
Thank
see you here
you.
today, Susan. And with that, well, this was a fantastic session. Thank you all for your really important, critical questions that we get asked a lot. So it was terrific to have them asked today and have them live in perpetuity for other entrepreneurs to listen to. So thank you for attending. Have a great Friday and a wonderful weekend. And we look forward to seeing you at other future events. Please check out next.law under community and events. We have a partner webinar coming up, our monthly Pitchmasters workshop, and then we'll be back together again for Founders Q&A in August. Hope everyone is enjoying their summer.
Thank
Take
you.
care.
Thank you.
Bye-bye.
Bye-bye.
Good weekend.
Bye-bye.